Hey, what's up guys? This is Mario from Trader Today, and in today's video I'm going to go over a general update of the market. I'm going to go over sector analysis, see what's going on in the market. It's been, I believe, like almost 2 weeks of earnings, and we still got like two to three more weeks of earnings, and I want to kind of see what's been the results so far of that move. So let's get started. So I'm going to go over the S&P 500. Again, this is a 1 year chart. If you guys could see, it was really nice, very nice trend in 2017 before the year ended. And actually, the first month of January, it was just amazing. It was going parabolic. Definitely the huge move. The reason why this big move was because of the tax cut, which was really a big deal. But then there was a huge sell-off on volatility. This is again was related to inflation. Fears of I guess I think it was mostly of wages rising too high versus unemployment being too low, or unemployment being at peak levels, meaning that in order for companies to hire more people, they're going to have to start offering more money. So again, that is inflationary. So you had these huge sell-offs, and then you had a couple bounces. And then you had this other sell-off right here. This was all geopolitical with the trade war with China. So there's been a lot of volatility in the last, I guess you could say, 3 months, after January. Because January was an amazing month, to be honest. But it's just been a lot of volatility. And I guess we were looking for, as an investors and traders, we were looking for to see how the market was going to react after earnings. So far, I mean, we did see the 200-day moving average hold, which let me show it you guys really quickly. The reason why I show the 200-day moving average is because it's a very important moving average that investors and traders from around the world look at and pay attention to, and it just shows support levels, momentum, and it just really gives you a view of where the market may head. So as you guys can see, it did held the 200-day moving average. And it did bounce after the first week of earnings. You did see a bounce. After the banks reported, some of the big tech, like the FANGs, Amazon, Netflix reported, including Google, we did see a bounce. But then last week we saw a retracement, a pullback. Again, now testing the 200-day moving average again, below the 50-day, which is a medium-term moving average. And now it's pulling back, and we're going to see this week if we're able to again to get above the 50-day moving average and break out of this high right here, this 271 area, 270 area, which is a very important level because we can get break into higher highs. So far we have higher lows, so higher low from this, higher low, and we want to see higher highs. So we get higher highs by the end of this week on earnings. That is really good for the market. Again, so that's very important to really look at. So let's look at what sectors are moving. What sectors are moving and changing and really helping the market out. And also let's look at what sectors are not helping out the market and see if that may change in the future. So let's look at the sectors. So I'm going to start with energy. Energy has definitely been helping out the sector. Even though it's only a small percentage of the overall general stock market, which represents, of course, the S&P 500. I believe the energy sector is around 5%, less than 10%. So it's 5%, which is very small. So even though it has been trending the last couple of weeks because of oil, it hasn't really helped out as much. But it a little bit goes a long way, I guess you could say. So utilities, again, they've been in a downtrend because of rising interest rates. They're kind of like when interest rates move up, utilities move down. When interest rates go down, utilities move up. It just because they're similar to how bonds trades because of the stability of the dividends and things like that. They trade similar to bonds, so that's the reason why you have that. So that's the reason why utilities kind of really haven't been doing much, even though it kind of did bounce a little bit. Market is not really looking at utilities. Real estate investments trusts, REITs, also doing the same, similar to utilities, same concept. When interest rates go up, real estate investment trusts go down. It's consumer discretionary. This is a really important one because it is a pretty, does represent a pretty decent size of the overall stock market. And so far, from what I'm seeing, I do see higher highs, which is good, and I do see higher lows. So that's really, really good. So we're hoping for that trend to continue. Definitely the FANGs are leading the pack, like Netflix and Amazon are part of consumer discretionary. So hopefully that continues to trend upwards, which is really, really good. Consumer staples, again, similar to utilities and real estate investments trusts, when interest rates go up, these type of sectors tend to go down. Technology, probably the most important sector, the biggest sector in the S&P 500, so, which is the most important to really look at and consider when it comes down to looking at the market. So right now, the good thing that we do see in technology is we do see higher lows, you can see. And now we did see a little pullback, but we're hoping that it breaks over this 68 level and we start seeing higher highs as well. So if you look at the 200-day moving average, you'll get a better sense of what investors are looking at, in the tech sector. So let's see how that looks. So again, it did test it around this area a little bit, and we did see it again. Now it's again trended. So I mean, honestly, the technology sector looks very similar to the S&P 500 chart. Why? Because the technology sector is the biggest sector in the S&P 500, so it is not a surprise. so hopefully, this levels hold. This low level, the 64 level holds, and we do see higher highs. So that's very, very important to look at in next coming week. So, all right, so that's that. The NASDAQ, again, is pretty much similar to the technology sector in S&P, which is XLK. So NASDAQ, XLK, very similar, ETFs. Now, just the one other thing I want to add is the NASDAQ is a lot more broader. It does include more smaller tech companies. So let's look at the financials. Financials is the second biggest sector in the S&P 500. So again, very, very important to really look at and think about when it comes down to analyzing the whole market as a whole. So far, it's been holding. I do like the fact that this level did hold, this 2670, 27 level hold, which is very important. I did create a lower low right here. The lower here is 2655. The low of this candle is 2676. So it's by a couple cents, so not a really big deal. So I almost consider it more like a double bottom. And, it did kind of hold this level. So it is trending, but we kind of starting to see the weakness after, especially the banks did report. So didn't help as much as I thought it was going to help. These 28 level seems to be resistance. Once we break out of the 28 level, then we can maybe see go up to 29 or more. Now let's look at the moving averages, see if they're helping out or what's going on with that, to see, kind of get a deeper look. So if you guys can see, it did get a chance to bounce and test the 200-day moving average, and there's a low right here, and it never got above the 50-day moving average, which is very, very important. So once it breaks over 28, it will go over this resistance level and also be above the 50-day moving average, which is a very, very important moving average to consider. Again, this is the second biggest sector in the S&P 500, so that's very, very important. For the market as a whole to trend and continue to make higher highs, financial sector needs to break over this 28 level and needs to break over the 50-day moving average. So all eyes are in financial because technology is doing good. Also discretionary technology, they seem like they're trending, they're making higher highs, they're doing their thing. Financial sector is not, which is very weird because interest rates are going up and the financial sector is actually the sector that benefits the most from higher interest rates. And not only that, but they also benefit the most from lower corporate taxes and deregulation of financial industry, because since Donald Trump, which is a Republican, did enter the White House, there's been a lot of regulatory changes. So they have been deregulating the financial industry, so it should be helping it, and it is. And the numbers are not lying. Just the market, for whatever reason, it's not liking it, I guess. So one thing I want to mention about financials is very, very important is the FOMC meeting is next week. So I kind of want to look at show you guys what is the I guess the probability of the FOMC, the Federal Reserve, increasing interest rates at the next meeting. So let me see FOMC rate hike meeting. Let's see what we can see. CME group. There you go. It's the FedWatch tool is actually what I like to look at. So countdown to the next FOMC meeting. Now the meeting starts tomorrow, and we're going to get an FOMC announcement on Wednesday. So according to a CME FedWatch tool, there is a 92.8 probability that the target is going to stay the same. So there's a 93% probability that they're not going to change interest rates. So that means that they're going to stick with the 150 to 175 basis points. So yeah, so I guess because of that, the market may like that. Again, because when interest rates go up, it does tend to hurt the market, because when interest rates go up, when the Fed raises interest rates, so do 10-year bonds, 30-year bonds, their interest rates, their yields will go up as well. And again, a lot of this volatility in the market has also been blamed on T-bills, on the 10-year or the 30-year hitting 3%. So, you know, by the Federal Reserve not increasing interest rates, I believe we're going to be fine. You know, hopefully the financial sector likes that as well, because they do benefit from higher interest rates. But, you know, hopefully they don't take it as a negative way. But in terms of technology sector, consumer discretionary sector, and other sectors, it's a good thing. All right, guys. So let's. I just wanted to cover that. So let's look at the materials. Actually, materials is one of the sectors that are not looking so hot. It does represent, I believe, around 5 or 6% of the overall market. So not too big of a deal, but it did go below its 200-day, broke above it, and then went below it again. So, you know, we're looking for this earnings weeks, and hopefully all the material stocks start reporting, and we get ourselves above the 200 and the 50-day moving average, and we can get some sort of maybe higher low around these levels, and that will definitely help out. Now, industrials not looking so hot. I mean, we are getting higher highs, higher lows, excuse me. But after this day, don't look good to me. And a lot of the thing about the industrial sector, a lot of it, a lot of volatility has to do with the trade war with China. And now we have to, Donald Trump does have to kind of give a follow-up on Europe, on France, and Germany to see if they're going to be excluded out of the aluminum and steel tariffs, or they're going to start including them and start charging them 25% tariffs for any aluminum or steel that comes from France or Germany. So a big deal. So of course trade, because I mean if that does happen, if Donald Trump does not, I guess you could say, take him out of that tariffs, there might be a trade war with Europe. There could definitely be a trade war with Europe. They're not going to like it, you know. And again, that's not good for the stock market. Let's just be honest. So we'll see. We'll see what happens, guys. So that's really what's happening with the industrial sector, which I personally don't like, because it's literally hurting the whole market as a whole. Now we have healthcare. Healthcare did kind of hold these levels. It's above the 200-day and above the 50. Actually, not above the 50-day. It did kind of close weak today, but you know, with the FOMC meeting coming soon, I do see hopefully this moving to the 86 level and breaking. It could definitely break over 86, and we're gonna have to see. But so far, it's not looking so bad. And now let's see biotech. Biotech is you know, we did have a Tesla 200. We had another Tesla 200, so it did bounce, create a higher low. Now, again, if it can sustain that and go above the 50-day and create a higher high above 92, we definitely are looking good in the biotech sector. So that's pretty much it, guys. Hopefully that made sense. Again, all the sectors that I covered they are part of the S&P 500. They are part of the SPY ETF, and the way they move is the way that the S&P 500 changes. So just keep that in mind, guys. That's the reason why I go over all those sectors. And so we're hoping that, in my personal opinion, that industrials does hold, and that Donald Trump does, I guess you could say, not put any tariffs on Europe, because that may cause a trade war with Europe. I mean, we already kind of have one with China, a really small one. And again, the worst thing that could happen is now have one with Europe, and then now everybody's going to be every man for himself, in terms of countries, and that's not good for the economy. It's not good for the U.S. economy. It's not good for the world economy. Hopefully we could come in agreements and kind of really see where the middle ground is, and really try to help each other out as countries. And my opinion as a trader and investor is always good to have a win-win situation for everybody. When there's not a win-win situation, that's when things go wrong. So, all right, guys. So hopefully you guys learned something from this video. You guys will hear from me soon. Have a good one, guys.